How's it going, everyone? My name is Derek Afasi. I'm the owner of Afasi Financial Group and RetireSharp.com. Today's topic I want to discuss with you, can you have an IRA and a 401k? And kind of what are the benefits of being able to transfer your dollars from a 401k into an IRA and when you are eligible to do so. So what I want to do is go over the pros and cons of a 401k, the pros and cons of an IRA, and then why it typically makes sense, especially when you're gearing up for retirement, to take old 401k monies or existing 401k monies if you suffice a certain requirement to therefore roll it over into a specifically designed IRA contract. So when we're going through the first topic regarding a 401k is a qualified employer-sponsored retirement plan. So an individual would start employment at a specific company, a private company, and this company will give them an employee benefits package. One of them might include that they could place certain dollars into a 401k plan. So think of that 401k plan as like a bucket. This is a retirement bucket. So if this individual is making money, has a salary, whatever it might be, they could take a portion of their salary, percentage of their income, and place it into this bucket. So if this person's making $100,000 and they decide I want to place 10% of my monies into the 401k account, that means obviously $10,000 is going into this type of plan. This money is going to have a tax deduction off of what contributions are being placed into this plan. So their adjusted gross income in this example would be $90,000 at the end of that year, except for instead of the $100,000 that person made, is because they were placing it into a pre-tax vehicle, something that would give them that tax deduction now. The monies that grow into this 401k, it's a combination by the contributions that are placed into this plan and then also the percentage rate that comes back regarding this specific type of plan. Now, what determines this percentage rate is typically tied to mutual funds. So when you're working for a company, you're offered a 401k plan, you might see a whole slew of different mutual fund options to choose from, maybe between like 5 to 15, 5 to 20 different mutual fund options to choose from. And it might say like conservative, you might see like target date funds, all these different things. Well, with these mutual funds, with this platform, I just want to clear off the screen, we want to make sure that the interest credit is as high as possible. So if you have limited funds, such as 15 to 20 different mutual funds, and they're garbage funds, well then you're going to have a garbage return. It's not going to be a favorable rate of return. Now, individuals that are investing into these mutual fund type accounts, yes, they want to say, okay, if I'm making money, I want to make sure that I'm saving for retirement, saving for retirement, saving for retirement. But it's the combination of what goes into this bucket and also this interest credit. So if this interest credit comes back negative, like it did in 2008, you have individuals that lost thousands upon thousands of dollars in their portfolio because they got hit with a 50% loss in their 401ks. It didn't matter how much they were contributing into this plan. It was because the mutual fund options were garbage mutual funds tied heavily to the market, and they just thought that the market was always going to be going up. So therefore, that account went down, the interest credit came back negative, and therefore cut the bucket in half. And that was obviously a big problem, is because they didn't have a whole plentiful amount of options like you would with an IRA to choose from. Now, the benefits of a 401k, and this used to be a lot more attractive a few years back and has really gone by the wayside, is the match. If someone, let's say if an employer is giving this employee an incentive to stay at the company, they could offer different things such as bonuses, or they could give favorable matches to their 401k plan. What I mean by that is, let's say if that individual is making $100,000 and the company says, okay, we're going to give you a 3% match on your money. If they go and they place 10% of their salary, just like that other example, into this plan, the company is going to be giving them, so this is $10,000, the company is going to be giving them $3,000, so now $13,000 was the contribution for that year. If they place in $2,000, well, that's only 2%. They're only going to get $2,000. So it's going to be a match up to that specific limit. In this case, in this example, it's going to be 3%. So you have more contributions going into this bucket, which should therefore grow that bucket larger and larger and larger. So when individuals sever employment with a specific company, they might have an old 401k plan that's sitting there. This is where the benefits of an IRA. You could establish an IRA on an individual side and just say, okay, I want to start contributing monies into an IRA plan, but you're going to be capped on how much you can contribute. You know, right around the $5,000, $6,000 mark, depending upon what year that you're placing those dollars into it. And it's constantly increases, but it's very low, especially if you have somebody that's making $300,000 in a given year, and they're going to try to establish an IRA, an individual retirement account of making, putting away $5,000. That's a drop into the bucket. So that's where an individual, typically when someone's establishing an IRA, they're from existing 401k accounts. So what this means is, let's say if a person was working, they kept contributing monies into their bucket, they were getting a positive interest credit. Now this bucket is nice and large. Well, we understand the downside is you're going to be limited on those different funding options. On top of it, you're going to be having to pay 401k related fees and those mutual fund related fees. And if you're having an advisor monitor those accounts, that's an additional fee known as an advisor fee. So all those negatives with the downward market losses that really hinder the 401k account performance. So after somebody leaves a company, well, now it gives them access to roll over their old 401ks. The reason why it's called rollover is this 401k plan is known as a qualified retirement account, and IRA is known as a qualified retirement account. So rather than taking the 401k out, and this actually happens more times than you would think, an individual thinks, oh, I have $100,000 in my 401k plan. I'm just going to throw that into my checking account. I left my employment. This is all my money. I'm just going to throw it into my checking account. And you have somebody that's like 40 years old that will throw $100,000 into their checking account. And what they did was they took their qualified monies and they turned it into non-qualified monies, and therefore they got dinged because they weren't 59 and a half yet. There was a 59 and a half rule with all these qualified accounts, both the IRA and 401k. So they're going to get hit with a 10% penalty. And then also this is going to go against their taxable income as well. So it's going to show as if they made an additional $100,000 that year. And therefore, like, let's say if this person's in a 30% tax bracket, they're paying $30,000, they're paying a $10,000 penalty, $30,000 in taxes, they're going to be able to walk away with 60 grand off of a rule that they just didn't realize. So what you want to do is say, okay, I understand the tax deferral benefit. I understand that if I'm placing contributions into a plan like a 401k or placing contributions into a bucket like an IRA, obviously that's going to grow the bucket, but it goes twofold. It goes by the contributions and the percentage rate that comes back. Let me clear off the screen because it's starting to look a little sloppy. So when somebody does the rollover from an existing 401k, let's say that example with the $100,000, and they roll it over into an IRA, now you have a whole slew of different benefits. You could shave down the cost of those mutual funds. You could go into ETFs. You could go into stocks, bonds, bank CDs, a whole slew of different things that you could establish your account into, money market accounts, whatever you prefer. But you have thousands of different options as opposed to leaving your monies in the 401k account, which you're limited about 5 to 20 different options, to choose from, which are going to be more expensive. Essentially can be more expensive with the 401k account. So the IRA, when somebody's eligible to roll over their monies into a 401k, whether they left employment, they've severed employment with that employer, they've hit age 59 and a half, age 60, some companies allow you to roll over your 401ks. Sometimes when you have a 401k plan provider that changes, they allow you to roll over those monies as well. And then especially when it comes time for retirement, you could establish specifically designed IRA contracts that work in conjunction with your specific goals. So what I mean by that is, let's say if someone's 50 years old, they severed employment, they now have this 401k that's sitting there on the sidelines. They started with a new company. That new company has a 401k plan. The constant mistake is this individual takes the old 401k and rolls it over into their new 401k, where they should be taking their old 401k and rolling it over into a specifically designed IRA contract. If growth is their goal, then set up an IRA with better growth strategies than what the current 401k is offering. If it's safety and income, well, then set up a specifically designed IRA contract with safety and income. In this example, if a person's 50 years old and they want to retire by age 65, you could actually set up guaranteed lifetime income streams through IRA annuity contracts that will get triggered at age 65 with a portion of those 401k dollars. So there's so many different things you could do with an individual retirement account that rather than just guessing and saying, oh, well, the 401k is convenient, the IRA, it's basically the difference of saying, okay, I have 15 different options or I have 15,000 options. I have, 5 different options or I have 500 different options. That same sort of concept is, you could really mold it specifically to your situation, or you could do multiple IRA contracts. You know, in this example, this person at $100,000, you could have maybe $50,000 that's segmented into an IRA annuity contract, another $25,000 that's set up into a a risky IRA, with risky goals. You can have another one that's set up for, more conservative goals on the other 25,000. You have 3 different IRA contracts established correctly, which would essentially beat out the limited options that you have regarding your 401k. That match is the tricky concept that individuals don't understand. If you have a bucket of $100,000 that's sitting in a 401k account, and you go and you roll that over into a new 401k account, well, if you're making $100,000 with that new employer and you're placing $10,000 into this plan and they're matching you 3%, they're not matching you 3% off of the overall bucket, or they're not giving you the match off of the overall dollar amount. They're just giving you off of that contribution for that year. So whether this bucket was $0 or whether this bucket was $100,000 is not going to make a difference, because of the fact that that match is only going to be based upon the contributions for that year. So I hope that all of that makes sense. So what we try to do with the Fosse Financial Group is we try to educate you guys. We try to say, okay, listen, this is your current situation. We're going to ask you a slew of questions to try to figure out what your goals are. And then based upon your current situation, are you going to be able to properly accomplish that goal? If not, well, then there might be some recommendations that we make. But it's going to be very transparent. We want to make sure that we're educating you guys through video tutorials, through literature pieces, different things to make you comfortable and confident about your retirement, to make sure that you're setting it up like a perfect puzzle piece, that everything could fit in your plan so that you have as much leftover monies as possible. If somebody has retirement assets of $500,000 in their 401k, they could go and, let's say they want to retire the next couple of years, they could segment a portion of this $500,000 to accomplish their exact retirement goal, so that they're preventing downward market losses, they're gaining on a consistent basis. Out of this $500,000, maybe this individual only has to use $200,000. So now they have $300,000 left over that they could risk, that they could use as fund monies, like you could use, towards vacations, towards travel, because $200,000 was segmented specifically with their plan, whether that's they're setting up their income plan properly, they're using that in conjunction with Social Security and pension income, they have emergency funds set up properly, they're protecting themselves against inflation for, step-ups in income. Everything left over, that the ultimate goal is to use the smallest amount of dollars and only as much as necessary into a specific plan, and have as much leftover money as possible. Because when you have as much leftover money as possible, obviously that's a good thing. Obviously you have the confidence to say, even if this was tied to market losses and the market went down, well, you're not freaking out as much because you've already preserved your accounts. You already established your plan properly off of your safe monies. You have to have that safety net in retirement. And this is this is what prevents individuals from outliving their retirement and being miserable in retirement, constantly stressed and looking at, their ticker and seeing their market performance. That's how you eliminate the stress, is by proper planning. And that's what we try to do for you guys. Our 1-800 number is 1-800-566-1002. You can give us a call 24 hours a day, 7 days a week. You'll speak with a specialist specific to what your needs are, and basically we'll have a conversation with you. We'll try to see if there are any gaps, whether you are currently sufficing those gaps off of your current plan could do that, or whether we could give you some good recommendations. But it's not pressure. It's basically we just want to give you the best recommendations, give you the best education, and if you're properly educated, you're going to be, properly confident in retirement. We are A+ rated on the Better Business Bureau. It's because of our methodical process, and we utilize a system known as the Retire Sharp Planning System that goes through all the top carriers, the top contracts, to make sure that we can mold it into this perfect puzzle piece. But I want to thank you very much for watching this video. Please feel free to subscribe to our YouTube channel, Retire Sharp, so you can have access to the most updated videos. Thanks so much, guys.